Hello everyone, welcome to our Egyptian online seminar group. First, keep your phones off. Then, if you have any questions, you can ask our speaker during his presentation or after his presentation. I have great pleasure of welcoming dear Professor Matthew again. Matthew is a professor of accounting at Texas A&M University. His research interests including how auditors and audit committees and regulators improve audit and financial reporting quality. He has published into ranking journals such as the Journal of Accounting and Economics, the Accounting Review, Contemporary Accounting Research, Review of Accounting Studies, Accounting Organization and Society, and Auditing, a Journal of Theory and Practice. He currently serves as an editor for Auditing, a Journal of Theory and Practice, and serves on the editorial board of the Journal of the Accounting Review and Contemporary Accounting Research. Now we will start our seminar with the Professor Matthew again.
All right. Thank you so much, Mohammed. Welcome to everyone. It's an honor to be here. Let me share my screen. Okay. So hopefully you can see the screen here. Let me move this bar here. All right. So the title of my paper is Audits of Non-GAAP Earnings, Evidence from Adjusted EBITDA in Segment Disclosures. And this paper, you can get it if you want, put the SSRN download there. So you're welcome to download the most recent copy. This paper is co-authored with two wonderful co-authors, Antonis Kartapanis, who is also at Texas A&M with me, and Ben Whipple, who is at the University of Georgia. And so a little bit of a background about this paper. The start of this paper actually happened when I was meeting with an audit partner a few years ago, and we were talking about various things. And he mentioned to me that there are actually some instances where he and his team would audit non-GAAP metrics. And I asked, well, where are those? What are those situations? And he said, well, actually, non-GAAP metrics are sometimes disclosed in the segment footnotes. And so when they are, we have to audit them. And so that was news to me. And after that, I teamed up with Antonis and Ben, and we started working on this project. Okay, so at a high level, this is the paper really, just in these boxes. So we have construct boxes here at the top. What we're thinking about from a research question perspective is, does auditing non-GAAP metrics, does that affect the quality of those metrics? And then from a proxy perspective, we're in the setting of adjusted EBITDA in the segment footnotes. And so I'll talk more about that in a bit, but that's the setting that we're using to capture the construct of auditing non-GAAP metrics. And then we have three primary ways where we're looking at or measuring the quality of the non-GAAP metrics. Okay, we're going to look at the persistence of the exclusions. We're going to look at analysts as kind of a benchmark, as there's a lot of literature that suggests that analysts are good at figuring out what accounting numbers should be. And then we're also going to look at the prominence of the disclosure of those non-GAAP metrics. All right. So before we get too much into the weeds, let's talk about why we think this question is important. And so to start off, it's just a fact that companies frequently use non-GAAP metrics. And so this started maybe 20, 30 years ago when companies started disclosing non-GAAP metrics. And it seems like investors find these valuable. And in fact, some evidence would suggest that investors find these numbers more valuable than GAAP metrics. And so companies are using these non-GAAP metrics quite a bit. And then at the same time, though, by definition, this is different than GAAP. In other words, these metrics aren't GAAP. And so managers could use these in a bad way. In other words, companies or managers could have incentives to report aggressive non-GAAP metrics that would be that could harm investors. And so with time, there's been some auditor and regulator related groups that have asked about or maybe advocated for audits of non-GAAP metrics. And so specifically, I have a quote here from the CAQ. So for those of you that don't know, the CAQ is the Center for Audit Quality here in the United States. And they're essentially an industry group representing the audit industry. and they lobby on behalf of the industry. And so they put out an article about non-GAAP metrics, and they weren't actually advocating for audits, specifically making non-GAAP metrics part of the financial statements. But what they were saying is they were saying, look, if these non-GAAP metrics were audited, doing that could actually bring discipline to management's process. In other words, management's going to know that these non-GAAP metrics would be audited, and so management would, behave more appropriately, perhaps. The PCAOB, which is the regulator of public company auditors in the United States, they have or had an investor advisory group, and this investor advisory group studied non-GAAP metrics in 2017, and this investor advisory group went a little bit farther. They actually recommended that non-GAAP metrics should be included in the financial statements. And because those metrics would be included in the financial statements, they would be audited alongside the rest of the financial statements. So we see here a couple of groups, interested in this. And then the SEC also seems to be concerned about firms' aggressive non-GAAP reporting. So you can see there are many SEC comment letters about non-GAAP reporting. And so for these reasons, we think this question is important. It's something that's at the forefront of investors, regulators, and potentially even auditors' minds. Now, what do auditors actually currently do? Well, in the United States, they have very limited responsibility over non-GAAP metrics. And the reason is because managers disclose non-GAAP earnings or metrics outside of the financial statements. So typically, these metrics are disclosed in earnings announcements or conference calls. And all these things are outside the scope of the audit. And so specifically, Auditing Standard 2710, this is a PCAOB auditing standard, it says that the auditor has no obligation to perform any procedures to corroborate other information. They are required to read the other information and consider whether such information is materially inconsistent with information in the financial statements. So in other words, let me try to explain this. I typically call this negative assurance, but the idea is that if for example, a company put a non-GAAP metric outside of the financial statements, maybe in the MD&A or maybe in an earnings announcement, the auditor would need to call out management if the auditor knows that metric is wrong, if it's inconsistent with what's audited. But they have no responsibility to actually go in and audit those specific numbers. So they're only calling it out if they know that there is an issue. So what about recent non-GAAP research on auditors? Well, the first line there, non-GAAP characteristics affect auditors. These papers, what they are looking at is instead of auditors affecting non-GAAP, they're looking at it the other way around. So they're looking at non-GAAP characteristics, and then how does that affect auditors? And so, for example, this Holloman et al. 2022 paper, they find that non-GAAP characteristics actually affect the materiality that auditors choose, as an example. Okay. Now, there are a couple of papers that actually look at the other way around. These are a little bit more related to this paper. In other words, they're looking at whether auditors actually affect non-GAAP reporting. But I would say that these papers are capturing an indirect link, okay? And so let's talk about these for just a minute. So high quality auditors, they're associated with higher quality non-GAAP reporting. Okay, this is this Feng et al. 2023. The idea here is that if you have a higher quality auditor, they're going to enforce higher quality financial reporting, and also potentially higher quality controls. And so the non-GAAP metrics are going to be based upon financial reporting and controls. In other words, the non-GAAP metrics are based on the same metrics as the GAAP metrics. And so the mechanism in this particular paper is that you've got, a higher quality underlying set of numbers. And so therefore, this would generate better non-GAAP metrics. This Heflin et al. 2023 paper, this is really a recent paper in CAR. And they find that auditors have clients with similar non-GAAP reporting. So the idea in this paper is that they're using this idea of auditor style. So auditors, they have to interpret GAAP, so the financial reporting standards, and they also have to interpret the auditing standards that they're going to apply. And the general consensus in the auditor style literature is that each individual audit firm has their own unique style or working rules, or the idea is that each auditor makes kind of this unique imprint on the financial statements of their clients. And so this Heflin et al. Paper, what they do is they take this idea and they apply it to the non-GAAP reporting, and they find evidence that, yes, it seems like there's this auditor style effect with with non-GAAP reporting. Now, the challenge of these studies, though, is that they don't examine settings where non-GAAP reporting is actually audited. And so that's, really the innovation of our paper. And so there's this quest, right, this journey, like how do we find audited non-GAAP metrics? A former PCAOB board member in 2019, he actually, mentioned the setting that we're using. So he said in a speech, he said, this can occur with respect to the footnote containing disclosure about operating segments. Okay, something examined as part of the audit. Okay, so Brown here is it's J. Robert Brown. He's talking about the setting that we're going to examine, which is that, look, there are some non-GAAP metrics that are disclosed in footnotes. And so why is this? Why do some companies actually report non-GAAP metrics in their footnote, in their segment footnote? Well, it's because US GAAP requires companies to disclose within the segment footnote the profit or loss metric that they use to evaluate segment performance. Okay, so the idea is that companies that have segments, they have to actually tell the world through their financial reporting. They have to say, hey, look, this is the metric that we use to actually evaluate the performance of our segments. And so that metric may be a GAAP metric, but it could also be a non-GAAP metric. And what we find is that this actually results in a lot of non-GAAP metrics that are reported in these segment footnotes. And that's what we're going to end up looking at. So let me show you an example. This is from a company called Axalta Coating Systems, and this is their press release. Okay, so this is their earnings announcement. And you can see here, this is the top part of the earnings announcement. They're highlighting some second quarter 2017 results, and they say net loss and adjusted EBITDA impacted by weaker average pricing and mix, partly offset by acquisition contribution. Okay, so they're highlighting adjusted EBITDA as a non-GAAP metric within their earnings announcement. And then later, this down here is later in the earnings announcement. They say adjusted EBITDA of $227.2 million for the second quarter, compared with $251.1 million in the previous year's second quarter. This result was led by the impact of lower average pricing and also includes slightly lower volume driven by Latin America and EMEA, et cetera, et cetera. Okay, so they're describing a little bit this adjusted EBITDA metric. All right, now, if we now move to the actual segment notes, okay, so this is in the financial statements for this quarter. Well, we can actually see in the segment notes, they're disclosing adjusted EBITDA right here. So we have this total of $227.2 million. And not only do we have that adjusted EBITDA number in the footnotes, but we actually have it broken out by segment. So we've got performance coating segment, we've got a transportation coating segment. And then the company here is describing even in more detail this adjusted EBITDA metric. Okay, so they're saying, look, the primary measure of segment operating performance is adjusted EBITDA. And this is defined as net income before interest, tax, depreciation, and amortization, and select other items impacting operating results. And then here's kind of the key part here. These other items impacting operating results are items that management has concluded are non-cash items included within net income, items the company does not believe are indicative of ongoing performance, or non-recurring, unusual, or infrequent items, okay, that the company believes are not reasonably likely to recur within the next 2 years. Okay, so in the end, they're saying, look, adjusted EBITDA provides a measure that management believes reflects the company's core operating performance. So because this is the measure that the company is using to assess its segments, the company then is disclosing adjusted EBITDA in the segment footnote, and then that means that the segment footnote is of course audited, and so it pulls adjusted EBITDA in this case into the audit. Here is also a piece of the segment footnote, so you actually have a reconciliation. So we're going from net income, we go down to EBITDA, and then we have all of these adjustments. Okay, these are these kind of optional adjustments that the company has chosen to ultimately define adjusted EBITDA. So this is showing the way that the company, Axalta, is actually defining adjusted EBITDA. Now, one thing to note here is that they're giving us as potential investors all these numbers, and these are all numbers for the company as a whole. if I go back one slide, you'll see that not only do we have adjusted EBITDA again as in total, but we also have it broken down by segment. So as we've looked through these, we typically don't see actually, a reconciliation here that would actually be by segment. That could be even more informative, I guess, for investors, but that's not how this is typically done. Typically, the reconciliation that's provided is for the overall amount. Okay, so let's talk about the hypothesis development. First of all, let's take the side of a positive effect. Why might the auditor actually help improve non-GAAP metrics? Well, first, auditors should audit each exclusion. Okay, so in other words, each one of these exclusions, the auditor now is going to potentially audit those because they're part of the financial statements. So they might actually exert additional effort. Okay, and there are kind of two ways to think about this. So first of all, there could be a line item on the income statement, and now it's disaggregated across segments. So if I go back here, this actually, if you go look in the income statement for Axalta Systems, this debt extinguishment and refinancing related costs, this amount is actually on the face of the financial statements. Okay, so now, this is listed here, and you might say, well, why would the auditor spend more time on this? Well, they might spend more time specifically on this line because, again, it's broken out between these two different segments. So here, part of that is going to be, for performance coding, and part of it's probably for transportation coding. And so one scenario would be that the auditor is going to do more work on this debt extinguishment and refinancing related costs because now that number, it has to be divided out between the segments. Okay, now a second reason though is that there could be additional effort for subcomponents of line items on income statement. In other words, all these right here, starting from foreign exchange remeasurement loss all the way down to the deconsolidation, none of these, I didn't find any of these actually on the face of the financial statements. So all of these are subcomponents of other items that are on the financial statements. And so the auditor might say, well, look, now these are actually being disaggregated. They're being shown in the segment note. And so we're going to actually do more work on these items. All right. Also, auditors typically would use analytical procedures to, ensure consistency across time. And so it could be that the use of these analytical procedures help make sure that when, for example, one of these adjustments is made in one period, that adjustment continues to be made in future periods. And so just by the use of analytical procedures, an auditor might help enforce consistency across time. All right, now a second reason for why there might be a positive effect is what I mentioned earlier from the CAQ. In other words, the CAQ is saying, look, managers might actually be less aggressive because they know that their metrics are about to be audited. Okay, so there's kind of two ideas here. The top idea is that, look, the auditor is coming in and actually forcing some changes. That's kind of an ex post idea. The ex ante idea here is that, oh no, like the manager actually knows that the audit is coming. And so because of that, the manager is going to put forth better quality non-GAAP metrics ex ante before the auditor audits. Okay, and so just as a little bit more evidence of how this might actually be true, EY in a thought piece in 2024, they actually said companies should proceed with caution if disclosing measures of segment profit or loss that are not calculated in accordance with GAAP. Okay, so EY is telling or advising companies to be careful, okay, if they're going to issue or disclose non-GAAP metrics in the segment for them. Now, okay, why might there not be effect though? Okay, so we've got some reasons why there could be an effect. Why maybe would there not be an effect? Well, one is that it's unclear what auditors audit against. Okay, so in other words, when we have GAAP, okay, or financial reporting framework or standard, that would actually say what the number or how the number should be calculated or formulated. But in this case, there's really not, a lot of guidance on the specifics. In other words, adjusted EBITDA for one company may be different from adjusted EBITDA for another company. And so what do auditors audit against? And so KPMG, in one of their recent thought pieces, they actually call this out. They say, look, it's unclear whether segment profitability measures considered non-GAAP today, but permitted under the ASU are subject to SEC non-GAAP measure requirements. Okay, and so you might say, well, what is this like ASU that we're talking about? There's actually a new segment reporting standard that's coming out here in the United States. And so it does various things. One thing that it addresses a little bit is how many non-GAAP metrics can be disclosed. Anyway, so the point here though is that KPMG saying, look, like it's unclear in the segment footnote when companies disclose non-GAAP metrics there. Well, it's really unclear if those metrics actually are subject to Reg G. And so Reg G is actually the SEC's regulation for how non-GAAP metrics should be disclosed. Okay, now, even if, Reg G is in play, in other words, if auditors are going to audit against Reg G isn't, that prescriptive. In other words, it's not nearly as prescriptive as GAAP. And so auditors likely have clients that determine non-GAAP metrics in unique ways. Like I mentioned a second ago, one company defines adjusted EBITDA one way, another one defines adjusted EBITDA a different way. And so what this does is it creates subjectivity in the audit process. And so this limits the auditor's availability, or I should say ability, to push back against managers because they don't have like a very prescriptive standard to focus on. And also, whenever there's a lot of subjectivity, auditors have a little bit of a harder time actually creating a standardized process for how to audit and how to think about a certain subject. And so, even kind of getting training and procedures for the auditors to be standardized, to actually enforce a certain way of thinking, that could be more difficult. Okay, and related to kind of this last point, there's actually some recent evidence in both Maximov et al. 2024 and Iggy and Stuber 2022 that auditors may seek to appease clients in subjective areas of accounting. Okay, so where there's a lot of subjectivity, again, that auditor may not really be able to stand firm, or at least as well as where there's more objectivity. And so it could be that auditors are gonna have to allow a little bit more subjectivity in the numbers. All right, lastly, there are lots of other parties that are really interested in these non-GAAP metrics, and also that are interested in the performance of the company and really in financial reporting quality. And so we've got boards that are interested, we've got audit committees, lawyers, analysts, the SEC. So all of these entities could and probably do monitor non-GAAP reporting in some way. And so it could be that, the audit of segment footnotes, that the audit of those particular non-GAAP metrics just really isn't very meaningful because of these other entities that are doing this. All right, so we have a null hypothesis here then. Audited non-GAAP metrics are not of higher quality than unaudited non-GAAP metrics. All right, so how then do we go about examining this? Well, we start with firm quarters with earnings announcements in the Bentley et al. Data set. Okay, and we're specifically starting in 2016 and we finish in 2019. We do this because in 2016, this was really when the SEC started to ramp up their scrutiny over non-GAAP reporting. And then we end in 2019 for really a couple of reasons. One is because we're trying to avoid any COVID effects that might affect firm disclosure. And then also, we're going to end up having to do a lot of hand collection. And so, the longer we make the data set or the time period, of course, the more data we're going to have to collect. So what do? Well, we extract segment footnotes, and we first find that adjusted EBITDA is the most used non-GAAP metric. Okay, so I guess I'll pause here and say, we didn't come into this project thinking, oh, we're going to look at adjusted EBITDA. No, instead, we thought, hey, let's look at these segment footnotes and let's figure out what's disclosed. And so we searched within these segment footnotes to try to figure out, well, what is the most common non-GAAP metric? And the most common one by far is adjusted EBITDA. And so once we found that out, we said, well, look, let's go ahead and then collect these. This is what we're going to use for our empirical proxy here. And so we hand collect adjusted EBITDA from earnings announcements and the segment notes. And we end up with 8,005 firm quarters with the segment notes and adjusted EBITDA in the earnings announcement. Okay, so to be clear, every firm in our sample, has two things. One, it has an adjusted EBITDA metric in the earnings announcement. And secondly, it has a segment note. Okay, and then the treated observations here are going to be the ones that also have adjusted EBITDA in their segment note. So we have 1,315 that, on top of having an earnings announcement with adjusted EBITDA and having a segment note, in the segment note, there's adjusted EBITDA. And then, so let's think about the design here. So what we're going to do is we're going to define first, our first kind of way to tackle this is we're going to define adjusted EBITDA quality based on how exclusions map into future operating performance. Okay, so the idea here is that really companies, when they're making exclusions, what they're supposed to be doing is saying, look, these exclusions don't really matter for the future. They're one-off things. They're non-recurring. And so we're going to take these things out to give you, the investor, a better metric of future performance, of what's going to be predictive of future performance. And so exclusions that have higher mapping into future performance are of lower quality. And exclusions that have lower mapping into future performance are going to be of higher quality. And so then what we do is we group adjusted EBITDA exclusions into two categories. Okay, we have the ITTA category, so the interest and depreciation, taxes. There's no real flexibility in those categories. In other words, they kind of just are what they are. That's EBITDA. But then we're going to also create the non-ITTA category. And so this is where they're not uniformly defined. And this is where managers have more flexibility. And we expect that the auditor is going to have an effect here, if anywhere. Okay, so let me go back to this example. These are the ITTA exclusions, right? Interest, depreciation, amortization. And then these are all the non-ITTA exclusions. These are the ones where management has the most flexibility to kind of pick whatever they want to pick to go ahead and exclude from to ultimately get to adjusted EBITDA. So if there's an auditor effect, we would expect it to be here. All right, so then the design, this is based off of several other non-GAAP papers. So this is a very common design. And so we essentially have future performance, so going out for 4 quarters. And then what we're going to do is we're going to capture the non-ITTA exclusions. Okay, that's here with beta 6. And then we're going to interact non-ITTA exclusions with the segment, with whether the adjusted EBITDA is actually in the segment note. So in other words, segment NG is capturing if this non-GAAP metric is actually audited. Okay, and so the idea here is that we would expect this non-ITTA exclusions, if they do have some prediction for the future, in other words, they are persistent in some way, then there should be a positive coefficient on beta 6. Okay, and that would be consistent with prior literature. Okay, so we would expect a positive coefficient there. And then if the audits of those exclusions actually result in exclusions that are less persistent, okay, then we'd expect a negative coefficient on beta 7. All right, so future performance, we're going to look both at operating cash flows and operating earnings. Again, segment NG equals 1 when the firm included adjusted EBITDA in the segment. So segment NG is when, basically there's an audit of adjusted EBITDA. And then beta 7, again, is our coefficient of interest. If the auditor matters, then, we would have a negative coefficient on that. All right, now, before we actually get to the regressions, the first thing we explore is we look at, well, are there actually differences between firms that have chosen, okay, to have adjusted EBITDA in the segment note versus not? And I don't know if we were surprised with this, but in the end, we didn't find a whole lot. So what this is doing is it's modeling whether adjusted EBITDA is in the segment footnote. So this is just a 1 or 0. And then we're just putting in lots of different determinants to see, well, what determinants actually predict, having adjusted EBITDA in the segment footnote. And so, we find essentially 4 things, right? We find like size and return ROA and institutional ownership and having a Big 4 auditor. Like those are really the only variables here that load. And so there wasn't really a lot to say about this. We mentioned it, of course, in the paper, but we don't really have a story on like why this would be the case. And really, even ex ante, it's a little bit unclear, why a particular firm with a segment, why one firm would actually choose adjusted EBITDA versus, a different metric for their performance or to assess performance of their segments. Okay, so then here's our main results, right? You can see here we have our operating performance measures as an independent variable. We have this design where we have, whether the segment footnote's audited and then adjusted EBITDA, and then we're actually interacting this audited metric with all the components of adjusted EBITDA. And so what we find here is, consistent with previous literature, we find that these exclusions are persistent. Okay, so they do predict future cash flows and future earnings. So they're not like fully transitory. And this is consistent with prior literature. And of course, they're not quite as persistent, obviously, as like adjusted EBITDA itself. Okay, if you look at the size of the coefficients here. But then, for our purposes, what we then find is we find this negative coefficient here, which is suggesting that when these segment footnotes are audited, adjusted EBITDA is actually of higher quality. In other words, the exclusions specifically are of higher quality because this negative coefficient is going to offset somewhat this positive coefficient. Okay, now I'm going to mention one other thing on this slide and we'll come back to later. But later we're going to get into some alternative explanations. And one thing I'm going to come back to is the fact that adjusted EBITDA itself does not show as higher quality. So you can see here, the main effect for adjusted EBITDA is positive and significant. But when adjusted EBITDA itself is audited, okay, again, controlling for these other things, we actually don't find a difference here. And so I'll come back to that later whenever we talk about some alternative explanations. Okay, so the first alternative explanation is, well, look, you're not really capturing the effect of the audit. Instead, when a firm uses adjusted EBITDA to measure segment performance, what really is happening is the firm is committed to adjusted EBITDA being of high quality. Okay, so the results are due to company or firm oversight instead of auditor oversight. And so if this is true, then results should concentrate in settings where firms have the ability or are more able to actually increase the quality of adjusted EBITDA. And so we capture that in two different ways. So one is we look at governance. And so we're saying, look, a firm that is better governed, well, when they commit to actually to using adjusted EBITDA as their performance measure, then they're also going to commit to making that measure of higher quality. And they're going to be able to do that if they have better governance. The second proxy that we're going to use is going to be managerability. So we've got, a governance type test, and then the second test is going to be ability. And the idea, again, is we're going to split firms based upon the ability of managers. And in the setting where managers have more ability, well, those are the ones, that where we should see an effect if this alternative explanation is true. Okay. So this is our split for above and below median on board independence. And what we find is that we find our effect exists in below median independence, and it does not exist in above median board independence. And so, again, if like this firm commitment story was what we were really capturing, we would expect there to be a result over here because the better boards would commit to actually having a better adjusted EBITDA metric. And that's not what we see. All right. And then here we're splitting on manager ability. So managerial ability. And so again, if the story is that firms commit to having a better adjusted EBITDA metric, we would expect the results to concentrate where managers are more able. And we actually don't see that, right? In other words, we see this very strong effect where managers are less able, and we see a much weaker and insignificant effect even when managers are more able. Okay, so that's kind of the first alternative explanation. The second alternative explanation that we've thought about is, okay, well, firms with more informative adjusted EBITDA metrics are more likely to use adjusted EBITDA metric to evaluate segment performance. So instead of it being like a firm commitment story, it's just, look, we've got, if you think about the chance or the choice of picking adjusted EBITDA to evaluate your segment performance, well, maybe it's the firms that have better adjusted EBITDA metrics to start with, they're going to pick those measures. They're going to pick that to actually be their segment performance measure. All right, so we've got to do some work around this alternative explanation. Well, if this is true, then the relation between EBITDA and future operating performance should be larger when EBITDA is disclosed in the segment notes. Okay, but that's actually not the case. So this is where I was telling you a minute ago, hey, look at this result in table 4. So the coefficient on adjusted EBITDA and segment NG is insignificant in table 4. Okay, so I guess I'll just go back there really quickly. So right here, this is an insignificant coefficient. So in other words, this is suggesting that, or it's at least inconsistent with the idea that the firms that are choosing adjusted EBITDA to be in their segment note, that those would actually be the ones that have higher quality adjusted EBITDA ex ante. Okay, so that result right there is inconsistent with this alternative explanation. But of course, we're going to do some other things as well to help mitigate this concern. So the first next thing that we're going to do is we're actually look at auditor effects. So in other words, do we actually see variation consistent with the way that auditors would actually audit adjusted EBITDA? So the first thing we're going to look at is materiality. The idea behind this is that as something becomes more material, it represents more of a risk of material misstatement for the auditor. So the auditor typically would produce or exert more effort whenever as materiality increases. And so what we're going to do is we're going to split on the size of these exclusions, and we're going to expect that the results should be concentrated when the exclusions are more material. And then secondly, we're going to do an auditor quality split. Okay, and so the idea here is that a higher quality auditor, they're going to be more likely to affect financial reporting quality versus low quality auditors. And so for our particular audit quality metric, we could have split lots of ways, but we actually looked at specifically income increasing misstatements. So the idea is that a statement that's a fairly objective measure that yes, there was, an audit failure. And so we're going to split on offices that, either have income increasing material misstatements or that don't. And so when they have those would be the low quality offices. When they don't, those would be the high quality offices. All right, so the first split here is on exclusions. And what we find is we find that the results really concentrate when the exclusions are more material. Okay, and so this is consistent with like where the auditor is going to be exerting more effort, where they're going to be more interested in actually auditing the exclusions themselves. And so this is consistent with, again, with our expectations, or consistent with the auditor actually affecting the quality of these exclusions. Next, we're splitting based upon auditor quality. And so here in the left-hand side, we have no income increasing misstatement. So this is where we have high audit quality offices. And then here we have at least one income increasing misstatement. And so these would be our lower quality offices. And so once again, we find the effect concentrates when audit quality is high, right? Now, one concern you might have is that, maybe no income increasing misstatements. Maybe those are actually, maybe that's just really capturing like small audit offices. So this seems like, a valid concern. Now, this kind of would be kind of against what we would find here. In other words, the auditor literature finds actually that bigger offices are the ones that provide higher audit quality. So, if the concern is that, there's some correlated omitted variable here of like office size, really these findings are kind of going against that. But in an untabulated analysis, we actually control for the size of the audit office, and we find the results are robust. Okay, so what else? Like we're trying to think of as many ways to examine these alternative explanations as possible. And so for this second alternative explanation, again, kind of the choice of, well, hey, if the client has, or if the company has better adjusted EBITDA metrics to start with, they're going to actually choose to select that as a metric for segment reporting. Well, two more ways to get at that. One is we do entropy balancing. So we balance on the first three moments of the observables of the firms, and we find robust results to that. Okay, so that's at least controlling for selection on observables. And then we also, look at differences in non-GAAP EPS exclusions. And so the idea here is that, if firms with more informative non-GAAP measures, if those are the firms that are also more likely to provide adjusted EBITDA in their segment notes, then we would expect that the quality of their other non-GAAP metrics also to be of higher quality, okay, even though those aren't audited. In other words, if one non-GAAP metric is of higher quality, it seems to make sense that all the other ones should also be generally of higher quality. So what we're going to do here is we're going to examine a non-GAAP metric that's not audited, which is non-GAAP EPS, and we're going to see if there are results. Okay, so entropy balancing, we continue to find robust results. In other words, we have a negative and significant coefficient on non-ITSA exclusions, and then our indicator for whether those are audited. And so this is consistent with our primary table 4. And then if we move to non-GAAP EPS exclusion quality, this is table 10. Well, now we actually don't find an effect, okay, which is interesting, and which again is consistent with the audit actually affecting things. So in other words, what we're doing here is we've taken non-GAAP EPS, and then we're taking the exclusions, and we're following a Kalev et al. 2008 paper, and we split exclusions into special items and other exclusions, or like non-special items. The idea here being that there's kind of more kind of discretion over these non-special items. Anyway, and so what we find though is that even in these other exclusions, there's actually no effect of the auditor. And again, this helps rule out this second alternative explanation because these exclusions are not audited. right? These non-GAAP EPS here is not part of the financial statements. It's not part of the segment footnote. And so we wouldn't expect necessarily the auditor to affect them because they're not auditing. And that's what we find. All right. So now we're moving out of kind of our primary design into a couple of different designs to further test our hypothesis. And so what are some alternative ways to measure non-GAAP reporting quality other than just, looking at the persistence of the exclusions? Well, one way that we can examine this is we can actually leverage analysts. So analysts should agree with managers when managers' non-GAAP metrics are of higher quality. Okay, so what we do then is we're going to do kind of two things here. One is we're going to examine the agreement between analysts and managers when these non-GAAP exclusions are not audited and when they're audited. Okay, and then we're also going to repeat that in a specialized setting, a setting where there would be incentives to actually meet or beat, or incentives to actually manipulate the non-GAAP metric. Okay, so when in meet or beat settings, the idea is there's lots of literature on this that would suggest that this is where there's opportunism. Okay, so if you see a company just barely meet or beat an analyst forecast, then there's I guess higher risk that was done opportunistically. Okay, then the second setting that we're going to look at, or the second alternative way that we're going to examine non-GAAP reporting quality, is going to be looking at the prominence of the non-GAAP metric. And so prior research finds that the better quality the non-GAAP metric is, or the higher the quality of it, that the more prominently it's displayed in earnings announcements. Okay, so firms, companies display better quality non-GAAP metrics in a more prominent position. And so if auditing improves non-GAAP metrics, firms should report audited non-GAAP metrics more prominently in the earnings announcement. All right, so let's look at analysts and managers first. I know there's a lot on this slide, so let me walk you through this. So in panel A, we're looking at the overall agreement between the numbers reported. And what we have here is we have two columns. We have this column here on the left, which is when you have adjusted EBITDA that's not in the segment note. Okay, so there's no audit going on in this column. And then in the right column, we have where the adjusted EBITDA is in the segment note. So this is where there is an audit. Okay, so if we look outside of this red box for a minute, here in this first column, both agree 617.617. So in about 62% of the time, okay, when the segment footnote is not audited, the manager adjusted EBITDA metric matches the analyst adjusted EBITDA metric. And then in about 29% of the time, there's going to be a disagreement between the analyst and the manager on that adjusted EBITDA metric. And then in about 9% of our observations, we don't have an analyst that's actually putting forth an adjusted EBITDA metric. We only have the manager doing it. Okay, you might say, well, where's the analyst only? Well, we don't have any analyst only because in all of our observations, we have like an earnings announcement that has adjusted EBITDA. So there's that bucket's not here. Okay, so now let's compare. The comparison here really is between this agreement number here, the 62%, to the same one over here. Okay, so in this case, now all of a sudden, adjusted EBITDA is audited. And in this case, we have about 71% of the time when adjusted EBITDA is audited, both the manager and the analyst agree. And so we have this statistically significant difference, this increase in percentage. And so this is consistent with the idea that, look, again, if we use kind of analysts as the benchmark and saying, hey, a measure that agrees with the analyst is going to be of higher quality, well, we can see when adjusted EBITDA is audited, it appears to be of higher quality. All right, and then again, we look now in panel B, we look at three different settings where there's a lot of opportunism. So we're basically measuring meet or beat scenarios. And in this case, we're measuring meet or beat in different ways. So we have, you're meeting or beating by 2 cents per share. You're meeting or beating by 2% within 2% of the forecast, of the analyst forecast, or by 0.5% of total assets. So we're just using different cutoffs that the literature has used. And in all cases, you can see that there's less agreement when adjusted EBITDA is not audited. And there's more agreement when adjusted EBITDA is audited. Okay, so this is a different methodology than the way we analyzed kind of our first setting. But in the end, this different methodology is showing a consistent result, which is that when adjusted EBITDA is audited, that audit seems to be making a difference, seems to be improving the quality of the non-GAAP metric. All right, and then this is the prominence test, okay? And so we measure prominence in two different ways. One is just how early the non-GAAP metric is in the earnings announcement. And then secondly, it's how close is the non-GAAP metric to the GAAP metric. Okay, so you typically per Reg G, the SEC would require in earnings announcements that a GAAP metric comes first and then a non-GAAP metric. And so we're just kind of measuring like how close is that non-GAAP metric to the GAAP metric. And so we have a positive coefficient in both columns. And what this is suggesting is that, again, when the adjusted EBITDA is actually audited, then the prominence of that measure in the earnings announcement is higher. So it's more prominent. And so this is, again, kind of the third way that we're examining non-GAAP metric quality. All right, so then we've got some untabulated analysis, really just kind of a primary one. So those of you that are auditors, you might have already been thinking about this. But, you know, auditors, they audit the 10K and they don't audit the 10Q. So in other words, the quarterly financial statements are not audited, they're reviewed. Okay, so the auditor is doing procedures over them, like analytical procedures over the quarters, but they're not actually doing, you know, necessarily a full audit. They're not maybe inspecting and confirming and doing some other test. And so, you know, what we do is we actually look, like, can we actually see a difference between if we just use the Q, so like Q1 through 3, versus if we're using the annual number from Q4, you know, for the annual year in the fourth quarter. So we actually, you know, find that, you know, we don't find differences. In other words, we find effects in both places, both under quarters or under 10Ks. And so, you know, like, what do we do with this? Well, it's possible that, you know, this is consistent with this idea that because the annual number is audited, it actually disciplines the manager through the quarters. Okay, in other words, the annual number is the sum of the 4 quarters. And so by auditing, this could actually constrain managers throughout the year. All right. But we do hesitate a little bit to actually draw strong conclusions about this. And the reason is because almost all of our treated observations are for quarters 1 through 3. Or sorry, almost all of our treated observations for quarters 1 through 3 also have a treated observation in quarter 4. In other words, in this setting, it's not a setting where a company would only have like a certain performance metric for the fourth quarter or for the year, but then have a different metric for Qs 1 through 3. All right, in other words, once they choose a metric, that metric is in place and they're using that, you know, for all the quarters and the annual. And so we don't have a setting where we can really very effectively try to differentiate between a review versus an audit. So we have this as an untabulated analysis, but we're not, you know, currently making strong conclusions about this because we just don't think that we can.
Professor Matthew?
Yes.
Question from Jason? Yeah?
Okay.
Yeah,
yep.
Can you hear me?
Yes, I can hear you, Jason. Yep.
Hey, so sorry about that. So I had one question about your table 10, I guess looking at the comparison of, yeah, this is the one.
Yep.
So one thing I was thinking about is that I think your argument, if I heard you correctly, was that you think that it's possible that the non-GAAP EPS exclusion choices that managers make could affect the choices for your your adjusted EBITDA exclusions, correct? Is that one of the assumptions you're making with this test?
Well, let me try to rephrase it because I may be making that. I just want to make sure I understand you correctly. The idea here is that we have this second alternative explanation where what we're saying is that in our main test, what we might be finding is basically a selection effect. In other words, we might be finding that a company with a higher quality adjusted EBITDA metric is going to be more likely to choose that metric as what they're going to use in their segment disclosure. And so what we're trying to do with this test is say, well, if that alternative explanation is true, if their adjusted EBITDA metric is of higher quality, then we would also expect their other non-GAAP metrics to be of higher quality. And one of those other non-GAAP metrics could be non-GAAP EPS. And so what we're doing here is we're trying to say, well, let's actually, do like repeat our test using non-GAAP EPS, even though non-GAAP EPS isn't audited. And if the selection effect is what's really explaining our original results, and we should also see a result here.
Okay, that makes sense. So
Yeah.
it looks like that test tends to address the selection effect, but it also might be doing something else, because if you believe that auditors could potentially affect the exclusion decision that are for EPS, then it's also possible that that could spill over to non-GAAP EPS as well. In that, I mean, if you think about it, it doesn't really look good. It probably wouldn't look good to the SEC if you had inconsistent exclusions and different exclusions. So if you had a chance to kind of compare the exclusions between non-GAAP EPS and your adjusted EBITDA figures.
Oh, I see what you're saying. So you're trying to say, I think, is saying, well, the auditor, if they're auditing adjusted EBITDA because it's in the segment note, part of that audit might actually enforce not only higher quality exclusions, but even kind of the choice of exclusions.
Yeah.
And you're saying that those choice of exclusions, it would be then maybe bad for the company to pick kind of like different, maybe not as good exclusions in the non-GAAP EPS metric. I think that's what you're saying. Yeah.
If there's inconsistency amongst those measures, that definitely looks suspect.
Yeah. So great question. So the short answer is no. Like, we have not gone in and tried to do that test. We haven't specifically grabbed each exclusion and then tried to map it into non-GAAP EPS. We can certainly think about doing it. These exclusions are well, they're pretty messy to look at. Just be forthcoming. But I like the suggestion, and so it's something that we could certainly look at. I wonder too if we could look at. I'm just kind of thinking out loud here, but under this scenario that you're saying, like if the company chose lower quality non-GAAP EPS exclusions, I wonder if there's anything we might be able to do around like comment letters from the SEC, because the SEC is going to be the one that's really going to be looking at the earnings announcement, and the auditor isn't going to be looking at that as much. And so I don't know, maybe that doesn't work, but we can think about that as well. So
yeah.
Awesome. Thank you so much, Jason. Yeah,
no problem.
Okay. Let's see. So we did alternative ways. Okay, on tabulated analysis, again, we're just like hesitant to make a lot of conclusions around kind of the Q versus the K, because again, we don't have a lot of variation there that we can exploit. So to conclude, our results, suggest that auditing non-GAAP metrics can improve their quality. This contributes to, a literature that's at the intersection of non-GAAP reporting and auditors. And really it addresses what we think is a pretty kind of timely and important question by regulators, at least here in the US. Now, what's interesting is that I know there's IFRS, I'm going off memory here, I think it's IFRS 18, that's been issued that actually is going to require some non-GAAP metrics in financial statements outside of the US. And so that's going to be effective pretty soon. So I think, not only does this paper, I think, provide some evidence that, supports, auditing non-GAAP metrics here in the US, but, it may actually apply in some other settings as well. Now, of course, a natural question would be is, does it generalize? In other words, does it generalize outside of the segment note? And unfortunately, we can't, speak too much to that. But we also complement non-GAAP studies, which primarily focus on non-GAAP EPS. In other words, most non-GAAP studies, focus on non-GAAP EPS, and a lot of that is because of the Bentley et al. Data set. And so, we focus on adjusted EBITDA, which is, actually a pretty commonly reported metric by managers, and it's frequently used by analysts. In other words, there's analyst forecast about adjusted adjusted EBITDA. And then, kind of our final contribution is that we do plan to make the data set available to future researchers. So we're hoping that's of interest too. So with that, I thank you very much. And if there are any other questions, I'm happy to take them.
Thank you very much, dear Sir Matthew, for your contribution and your effort. It's really an excellent presentation and excellent paper. Thank you very much. Now, if anyone have any questions, you can open your mic and ask your question. Yeah, Ken?
Yes. Well, first, thank you for the wonderful presentation, and I like the idea of checking out the quality for the adjusted EBITDA rather than just regular non-GAAP earnings. So I have two questions here. My first question is, when I check out your table, I found that you control for the calendar year fixed effect. So I'm curious, why don't you control for the quarterly fixed effect?
Okay, that's certainly something something we can do. So we can check that out. Do you have a specific concern there?
Just because your setting was on quarterly, so I was thinking that it probably is a better fit for using like a quarterly fixed effect to kind of controls for the variation within the quarters.
Within the quarter. Okay. Yep.
And my second question is related to I don't remember what exactly the table numbers, but it was like all those like high versus low. And then your explanation was that, well, the negative significance between the interaction terms only show it in a certain group. I mean, I don't remember exactly. So my other question is that, have you tried to compare the coefficient of that interaction term between the high versus the low group to see whether there really a significant difference between that? And the reason why I raised that question was because now, personally, when I was conducting this non-GAAP research, so sometimes I was able to find like significance in one particular group, but well, that could be due to like the observation and other situation within that group. So when I compare the two coefficient, then I really could not really find the difference in there. So I'm not saying that is a major concern, but I'm just saying, maybe if you can find the significant difference between these two, you could add it in the footnotes. That was just one other point.
Yeah, no, I really thank you so much for that suggestion as well. Yeah, we haven't done that yet as far as putting in the paper. I know at one point we did check, and I can't remember, where it's significantly different versus others. There's kind of a couple things are going on here as far as like why we didn't actually put that in yet, but maybe we should and we could. And that is that, from a prediction perspective, we're not necessarily predicting like a greater effect in one versus the other. We're more saying, hey, the effect should concentrate in one versus the other. And it's a little bit of a nuance. And again, maybe we should go ahead and add the significant difference or whether it is or isn't to the paper. But there might be actually like not an effect in one and an effect in the other, but then no statistical difference between the two, because there could be a really high standard deviation in the one where there's no effect. And so that really high standard deviation, may cause insignificance in that sub sample, but then it also may result in kind of a lack of significance difference between the two subsamples. So anyway, so far what we've done is we've only included, like you said correctly, we've only kind of focused on, is it significant in one versus the other, as opposed to focusing on whether it's a statistically significant difference between the two, primarily because from a prediction perspective, we're saying, look, we expect it to concentrate in one and not concentrate in the other. But your point's well taken. It's something we can certainly think about. So thank you, Ken.
Thank you. That was exactly what I meant.
Yep.
Another question? If you know, yes, you can ask. Oh. Rafid, you can ask, yeah.
Hi, hello everyone. Thanks for this detailed presentation. I only have what I may qualify like a general question. Can you hear me clearly?
Yes, yes.
Right. I'm a little bit, if you like, intrigued by this dichotomy, so to speak, between GAAP and non-GAAP. Yeah. And what came to my mind, since the non-GAAP reporting is very widespread, in other words, it has gained momentum over the years, and it is, it is there. Let's say it is there to stay, and maybe eventually it will probably push out the GAAP. The GAAP is because companies are after, if you like, releasing a type of information, maybe to gain access to capital markets. They're trying to give a particular type of information, or paint a particular picture. So I was just wondering whether this type of study will help maybe put an argument forward and say, instead of having this dichotomy between GAAP and non-GAAP, why not say we have enough practical evidence, empirical evidence, that says maybe the GAAP need to be revised. So we don't need to have these two labels, okay? We need to make, if you like, we need to evolve in a way the GAAP and make them suitable for what managers need in their dialogue with existing potential investors. Because for like one thing and I hope I did understand correctly, is the need maybe to audit the non-GAAP disclosures, okay, to give them maybe more credibility. But why not go further than that? Okay.
Yeah, those are good points. I mean, I certainly don't have all the answers there. I mean, I will say that I think there's this idea between if you make something GAAP, typically you're enforcing something that's kind of consistently defined across companies. And I think companies might argue, well, we want flexibility to create unique measures because we're unique. Now, whether we believe that or not is another story, but that's, I think, an argument for having these non-GAAP metrics. So then the next question is, well, okay, if we have these kind of, if we want to allow this uniqueness because analysts and investors demand that, then should we audit it or should we not? You know, our paper suggests that there are some benefits to auditing from a quality perspective. Now, we don't capture anything on the cost side, so there could be a cost to it, of course. And then another thing that's kind of interesting to me is that, you know, of course, different jurisdictions do it differently. So again, like with IFRS 18, I'm not an IFRS expert by any means, but my understanding is that IFRS 18 actually requires different types of non-GAAP metrics to be in the financial statements, and then that's going to impose an audit of those. So wherever that's being implemented, I think there's actually going to be audited, like more, it's going to be more common to actually have non-GAAP metrics being audited. Whereas in the US, at least, these non-GAAP metrics are only audited in this kind of unique situation where they're in the segment note. So anyway, I think it's a very fascinating discussion to have, and I certainly don't have all the answers, but I know there are kind of arguments on all different sides of this.
Thank you.
Are there other questions? If anyone have any questions, you can open your mic and ask your question. Yes, Angie, you have a question?
Professor Matt, I mean, the paper is very clear and the presentation is really to the point, and it is of essential timing that we talk about the disclosures and how they're being audited. And we do appreciate you introducing this topic. I wasn't sure if since we're increasing the auditor's responsibility, I'm not sure if you touched that on your, maybe I missed some of the slides, but about the auditor's efforts, since it's going to be increased, would the audit fees play a part on this?
Yeah, great question. So I think that's a natural question of would audit fees increase? The idea there being that if the auditor is exerting more effort, then you would have an increase in audit fees. So that's something that's not in the paper. It's another thing where I know Ken asked a minute ago about the difference in statistical significance across columns. I know we've looked at audit fees at some point in this paper. It has evolved with time, and so I actually can't remember what the results are at the moment for audit fees. But that's certainly something that we could include. It would make sense that audit fees could increase because of effort. But yeah, that's something that again we can add in. I apologize, I don't have a precise answer for you right now because I just can't remember what we found.
Professor Anna Marcos, you can ask. Yes.
Hi. So I also have some research on this topic, and I've been following up what the ISB does, right? So sure enough, the IFRS 18 not only puts two subtotals in the income statement that are, as of now, non-GAAP measures, right? The equivalent, let's say, of EBITDA and operating income, although they have different, slightly different names. It also forces all the other non-GAAP disclosures to go on a specific note to the financial statements. And so with these two things, right, automatically all non-GAAP performance measures that the firms want to disclose from 2027 onwards, right, because it's still not applicable, will be audited. So that's one of the things that they were looking for, right? Is they have disaggregation, like the FASB is now discussing some more disaggregation, but they also put it on the income statement. So in part, they have what the other professor was discussing. Should we not then kind of integrate them into GAAP? So in part they do that, but only with two measures. But then they still leave the flexibility of, if you want more measures, yeah, you can still have them, but you then have to include them in a note and provide a reconciliation and an explanation on all that basically Reg G requires, right? But in that specific note. So I think, let's hope, right, that there will be more comparability and more consistency with those two things, right? Because the ones that are now in the income statement, of course, they are there, so you can clearly see it from year to year and across firms. And the other ones, I assume that there's going to be a lot more variation in those ones, the ones just in the note, but still you have an explanation and you have a reconciliation, so it should be clearer, and the auditors will jump in, let's say, because now they are part of the financial statements. So thank you.
Yeah, thank you so much for that institutional detail. That's fascinating. Thank you.
Are there other questions? If anyone have any questions, you can open your mic and ask your question. Thank you very much, dear Professor Matthew, for your contribution and your effort. Thank you very much. Thank you very much, everyone joining us today. And thank you very much, dear Professor Matthew, for taking the time out to present to us. It's really appreciated. Thank you very much.
Yeah. Everyone have a great evening or afternoon or morning, wherever you're located.
Yeah, and I hope to see you soon in Egypt. You are very, very welcome.
Oh, that would be wonderful.
Yeah.
Thank you, everyone.
Thank you. Good.